Happy Friday, everybody. Welcome to the TraderMerlin Show. It is your weekend edition. Cheers, everybody. This is, you've been asking, what am I drinking? This is the Frey Ranch Bourbon out of Nevada. Love it. It's a good one. And it is a reflection of this trading week. It was a rough trading week for me. It's the first, I actually had a losing week. I normally don't have losing weeks. I'll have losing days, but I had a losing week this week. Got me off guard in a few things, particularly my silver, but it's all right. Not the end of the world. We will recoup that as we progress. I'll talk about those trades, the markets, and other things as we go. But let me have a nice little sip of this whiskey, and then we'll kick things off. And cheers to all my friends out in Colorado who are attending the annual run of Fish for 4 nights out in Commerce, Colorado, which I am not attending, unfortunately. I wish I was, but not there. Okay, GD, HKD closed at exactly $100. Oh, it's torturing me. All right, Margaret asked me about what this graphic means. This kind of, as you know, I always try to find something that reflects kind of the mood. And this is like, I looked at it this way. It's kind of like a dome, those little siren bubbles that he's caught in. I think we're kind of trapped in that little alert going off and kind of chaos in the background, fires and flames and things like that. And I thought, well, that's somewhat reflective of today's trading activity. So, for example, I was watching and trading this morning and completely caught me off guard, that market move. Let me start things off with the daily. Everything was looking good. We had that nice little gap up. We had the nice little run up. Everything should be going fine here on my stream. I'm getting really weird messages, by the way, so just curious whether you guys are seeing anything wrong. Should look good. Okay. So here's where it caught me. Everything was going good, and it kind of hesitated, and then, as you can see, we just rolled over right after 9 o'clock, and it was pretty much aggressive down all day. Not exactly sure what that was, and unfortunately, since I was manual trading and didn't have stops in the system, I took some losses that were greater than I anticipated doing. So, unfortunately, that one caught me. And I'm still trying to come up with some justification. All I can really think of is it is this still overall panic mode. Now, since this is a weekend wrap-up edition, let's real quickly start things off. What I'm going to do is do three things. I'm going to start off by reviewing these markets from top to bottom for the day, because obviously there was some pretty nice daily activity. Number 2 is we'll look at it from the weekly perspective, and I think that's really important. And then number 3, we'll go and look at kind of hypothesis or ideas of where this may be headed. And I'll be honest, it's pretty tough right now to really figure where this is going. It is real choppy and odd. So let me start things off at the bottom. And NASDAQ was your worst performer. I will put this on a daily time frame. You'll notice the way that it moved, though. If you did follow my rules for shooting for a hammer formation, you actually would have had a really nice trade on this morning, right? It opened up down below it, it ended up moving up above the hammer formation, and then gave it all back and then some near the tail end of that session. But the picture is what's really ugly. NASDAQ was down 1.32%. S&P wasn't far behind, it down 0.91%. Not breaking the lows of yesterday, but coming awfully darn close to it. You have the Dow Jones Industrial Average, so we have the indexes bringing up the bottom here. Here is your daily for the Dow, down 0.9% to 31,378. And, I was really anticipating a bigger follow-through. I thought we might see a 2 or 3 day rally. Nothing huge, but a 2 or 3 day rally that could get us back up to, maybe the 32.3 or maybe even that 33.2. But unfortunately, just really there was no follow-through at all. Here's your Russell 2000, which had an even weaker picture. It barely broke the highs of yesterday and then gave it all back. This is a pretty ugly picture for the indexes, and you notice that the Russell hasn't had a positive day in 6 trading sessions. Pretty ugly. Yes, GBT, happy hot Friday to you as well, and I hope everybody stays nice and cool out there. I'm in this state with all the crazy regulations or rules that might do rolling blackouts, so let's hope we make it through the show before we get shut down by the rolling blackouts that are happening. All right, top 3 for the day. Bitcoin, hallelujah. Although, look at the chart. Bitcoin might be one of the best performers of the day at 0.41%. But really nothing. I mean, it's literally 5 days in a row of nothing for Bitcoin, which I'll take it. I'll take a nice quiet sideways move as opposed to a big aggressive down move. That said, I'm a huge fan of impulse and corrective phases, and I think most of you know what that means. Generally, the impulse is the strongest, most aggressive move, and that's indicative of what the major trend is. A corrective phase is a move that's slower, not as aggressive, and it goes counter the impulse move. Well, if I look at this price chart right here for Bitcoin, let's just zoom into this price action right here. You have trending down, huge impulse down, and then sideways move. Another big impulse move, sideways move. So I'm not feeling very confident because based off what we're seeing, at least since mid-August, is lower lows, lower highs, and impulse moves are driving the train, which means we could very easily see ourselves back down near this 18.3 mark, which was the low, or this is the low for my demand zone going way back. So that's not a great picture, but I'll take a sideways day any day. Sure, Indigo says Seattle is nice and cool. It is, but how many days of sunshine do you get a year? What's the depression rate up there? I mean, if you love clouds and gloomy weather, Seattle's the place to go. I want sunshine and hot beaches, so you can't go out to your beach unless you're in a parka. I'm just kidding. I love Seattle, actually. Tom's Thai food in downtown Seattle. Oh, mamma mia. All right, exactly, Margaret. That yellow box. So I have this yellow box drawn over here, but we could very easily just take another one, and I'm going to not leave it here, but, very simply put a yellow box right across there, turn my magnet off, and basically, if you're in Bitcoin, you're saying it's going to stay within that range. If it stays there, great. If it breaks out of it, up, go long. If it breaks down below it, go short. I mean, let's not overcomplicate things with regards to charting and technical analysis. Keep it very simple. So I'll leave that little yellow box. So that one's due for you, Margaret. Moving on to number 2, crude oil up a little bit. Thank goodness after that 3-day slide. It was 0.58% gain, closing at $87.11 per barrel. The dangerous piece here is we are still stuck at those lows, and we're right near those lows we achieved back in the middle of August, and that's the line in the sand. In my opinion, if we break that 80, 85, 86 mark, you got a long way to go down. And I don't think we'll be challenging the $66 mark, but boy, from a technical perspective, this definitely looks very, very weak. Even though we did make a newer high recently, it screamed back down towards that lower demand zone. We'll see if that one holds going forward. All right. Finally, best performer, thank goodness, gold. You almost had an engulfing formation today the way the markets closed. Gold was up 0.85%, closing at $1,723 per ounce. Long way to go to get back up to my my objective target there, which is $1,750. Well, it's only $27 away. But good to see a nice little positive move out there. Silver was up as well. Now, I'm going to real quickly switch us over to a weekly chart just to paint that picture. And I didn't have time today. I apologize. Normally I like to do like a weekly percentage move for the markets wrap up, but I didn't get a chance to do that. If you want it, I can do them live as we go. The reason I have this hockey goalie alarm sound, as Tom puts it, or for me, it's just kind of panic mode and like, oh my goodness, warning signs, is if we are in fact in a strong bullish market, the pullback shouldn't be that big, right? You should have a small correction and then the impulse move back to the upside. Well, if you notice what's been going on here, we had 4 weeks in a row of up for gold. That was from July 18th, the week of July 18th to August 8th. That was 4 weeks in a row of up. But that was coming off the heels of 5 down weeks. So those of you who were talking, remember Jeff Manson's session the other day, you had 5 days in a row. Usually that 6th one's going to be up. Well, in this case on the weekly, you did have that follow through. What makes me a little bit nervous here is it seems like the downtrends in this have been more aggressive. Same thing for the equity markets. And they tend to be a little bit longer, which would make them the impulse direction, just at surface evaluation, which means that I feel more inclined to think that prices of these are going to continue to drift down. So it doesn't make me feel great when I look out at these overall index prices and what they've done. Here's our numbers for gold for the week, just to put it into perspective, because it was at one point we were down only 2.9%, finished down 1.53. So that's easy. Crude oil, though, had a much bigger decline this week, dropping at the end of the week down to 6.36%. At a low, it was actually 7.61. So that was one of your bigger losers. Bitcoin, well, that's just almost unchanged, right? At least for the week, it's just a flat little doji. Sorry, I'm doing this week. There we go. Russell. So our indexes are the ones that took big hits. Russell down 4.53. At one point, it was down actually 5.34. Dow, I won't do the Dow because it's a waste of time, and I got other things I want to talk about. S&P finished down 3.11%, and then the NASDAQ taken on the chin down even more, finishing down 3.88% on the day. Or on the week, excuse me. So there you go. I shorted the Monday candle. Good for you, Margaret. Did you close it out for the weekend, or are you going to take that one? And I saw a couple people here, commenting on that, talking about maybe taking some money off the table. Indigo says people closing positions for the weekend. Maybe. It was just a really aggressive sell-off near, right after 9:30, which caught me off guard. I really thought we'd see more of a rally, especially when you look at the economic data, right? The economic data wasn't that bad. I'll have a sip of whiskey. I'll tell you all about it. So when you look at this economic data, the unemployment rate was, I mentioned on the show yesterday, I did expect it to be higher than 3.5. I thought it'd be 3.6, came out at 3.7. I think that Jerome Powell teed this one up. This should not be a shock to the system. This should actually be acceptable and understood and absorbed already that unemployment data came out. I don't believe the sell-off was because of that, because this data came out before market open. So you should have been fine there. 1 hour before market open. If you look at factory orders numbers was bad. That shows a pretty big contraction. That happened about 10 a.m. So that, was that the big shock that really sent everything reeling? I hard to believe that would be the factor that drove everything down. One of the major announcements for the day was non-farm employment change. And this, of course, was a pretty big decline. This is the number of jobs being created. And you had 526,000 was the previous month. They expected it to be 295. We came out at 315. So while we beat expectations by 20,000 jobs, we missed the previous month by 211,000 jobs. So pretty big decline there in non-farm employment change. What I did see, and I don't have the chart here with me because I've just been too damn busy, is the labor participation rate, which John O'Donnell has been pointing out, saying, hey, this is a really important thing. We're seeing that number just drift lower and lower and lower. We actually had a tick up in the labor participation rate, which is a really positive thing and may have counteracted some of these non-farm employment data and the unemployment rate. So there's your economic data for the day. Let's see. I guess you guys testing all kinds of good stuff. Odds of the dollar making new all-time highs before year's end. All-time highs? Are you talking the Dixie, like the dollar index as a whole? Well, let's go out here and look at a weekly time frame. And you said all-time highs by when? Let's before year's end. I'm going to just say this. It's not that there's not a chance, but the odds of the dollar index making an all-time high is pretty much like Jim Carrey in Dumb and Dumber getting the girl, right? Yeah, it could happen. It would be a catastrophe. I'll just tell you this. If the dollar, which is currently trading at 109, got to all-time highs, which is right around 170, these markets would be in free fall. We would be in a major, major, major financial problem in the U.S., and it would be chaos. So let's go, so I can go monthly. How far back can I go? So your peak that goes all the way back into 1985, that dollar index was roughly, call it 170 or 164, right? So way up there, way up there. Right now, could we be at 119 or 120 by the end of the year? Yes, I definitely think that that's still in play. I think it's actually looking pretty decent. It would have to have a really aggressive run to get to 120, but look at the run we've had going all the way back to May of last year. It's been beautiful, really strong. I've been saying on this program for a while, I'm still bullish on the dollar. It seems to be the place where everyone's running to, whether it's to capitalize on the carry trade or just the reduction of supply. Dollar will probably continue on up. So good question, Joe, but I don't think it's going to be at all-time highs by the year end. I would definitely take that bet that it will not be there by year end. More interestingly would be, what about that 113 mark, right? 113 becomes a very real reality, and you can see I've got this line at 113.84. I'll break that down to a daily so you can see why that is. So that's not even on the chart right now, but I'm going to zoom over here. We'll scroll way back. Come on, keep going. That's 103. I need to get to 113. What's going on here? Where are my charts? That's how far back I got to go. I got to go so far back here. It was 20 years old. So that 113 level is, for me anyway, and again, I draw my zones differently than other people, is based off of this little area where you kind of had the downtrend, a little bit of hesitation, and then it broke back down aggressively. And that was all the way back into 2002. Literally 20 friggin' years ago is a level I'm looking at as a potential target here. And it's only 4 points away. It's not that far off. But remember, the stronger the dollar gets, the more pain it puts on the equity markets. So something to keep an eye on is obviously this dollar strength. If that keeps on going, we could have some serious problems for our equity markets going forward. And let me just click that just so we can see what's going on right now. There's your daily on it. And, we broke out yesterday, a little bit of hesitation today, but yesterday's move was strong and it held, rallied all the way up to almost 110. So things are looking pretty good. GD says, if the dollar hits all-time highs, it could lose its reserve currency status because small countries would ditch it. No, I don't think that's what would cause it to lose its reserve currency status. I don't think that would make too big of a difference. But I think the issue is it would be bad for anybody else. Anybody that's trying to convert to dollars is going to suffer. So, for example, if you are Saudi Arabia, you have to convert your currency into dollars for oil, right? It's paid in oil. It's priced in oil. I say it's priced in oil. It's priced in dollars. Same thing with gold and silver. Internationally, it's the commodities are pretty much priced in U.S. dollars. So the more expensive that dollar gets, the more expensive those commodities are for anybody around the world. So it certainly would put pressure on other economies, but I don't think it would necessarily detract it or make it lose its world reserve currency status. Now, what could happen out of this is you might start hear more talk about that there needs to be a change in the reserve currency, and we may see something rise up out of the ashes or unify together to pick a currency or work together to maybe make a replacement for the dollar, but it's not something that's going to happen like that. It'll take some time to get there. Yvonne says, poor Europe. Yeah, Europe, pretty ugly. Let's check out the euro dollar today. Here is the euro. You can see that yesterday was just its really aggressive down move. Today, still down sub $1, so we're below parity, which is great for me as I will be traveling to Europe and keep falling. Let's get to 0.86 like it was back when I took my job in Europe, all the way back in 2001. Crazy, you'd think we go back. Would you argue the dollar is closer to its peak than not, even with the bullishness? With this, I don't think I'm going to try to say, the dollar's peaked and it's going to turn. This has been a problem for me years ago where I'll anticipate that something's about to end. Let's say I'm in a long trade and I think, it's going to keep on, it's going to stall here and come back down, so I just sell it. And then you go back a week or two later and you're like, holy cow, it's up another 50, 100%. I should have just stayed in. The ultimate picture of a trend is really what this dollar has been showing since 2001. Now, granted, we had a little bit of chop here for, a few days recently, but pretty much rally, pull back, rally, pull back, rally, pull back, rally, pull back, impulse correction, impulse correction, impulse correction. I mean, you guys can see that over and over and over again. So, this right now is what you want to be long on, and take it. Just keep going long on the dollar. Yvonne's in the UK. Yeah, it's funny. We were actually talking about that. Like, what are the odds of the British pound going to parity? And I mean, look at this trend. This is just the daily time frame. Back in 2021, the British pound was at 142, and now it's at 115. I mean, that may not seem like a lot to you, but for anybody who lives over the UK that's come to America, their purchasing power has dropped by 19%. That's massive for a currency. That usually does not happen like that. So you can see it's accelerating. This down move in the British pound is even more aggressive than it has been. You've got impulse, sideways correction, very brief here back in mid-August, late August, and now 6 days in a row of just aggressive sell-off. That's because of the dollar. Dollar's become that safe haven that everyone's running to. Doesn't make much sense considering that we are in a really messed up place. But as John O'Donnell, what did John O'Donnell used to say? He used to say something like, we're still the prettiest girl at the ugly girl dance or something like that. I'm like, that's just inappropriate. But bottom line is, out of all these bad currencies and fiat currencies and just messed up governments around the world, people still look at the U.S. and go, well, you're better than most. Really think catching a knife, shorting the dollar at 112 might be worth it. Shorting that dollar at 112? So if we look at that trend again, and let me go out to the bigger time frames here. I apologize, I keep zooming in and out, but it's just the scroll mouse on this thing. I would let it. Well, we didn't even stop at this last one, but once we get up to that 113 mark, would you want to take a short position? You could, but you got to understand you're going against the grain on one of the most powerful trends we've seen in our market right now. So you can always go counter trend as long as that's a strong supply zone. I just be very careful with that, simply because the trend is your friend until the bend at the end. And you've all heard the phrase, picking tops and bottoms leaves you with stinky fingers. So there you go. I guess in terms of years a day is not silly question. What would be the impact of losing the reserve currency status? The reserve, okay. Now, I want to have more macroeconomists on the program to help with that one. So if you look at most of the countries around the world, talking Europe, talking Japan, talking UK, talking China, Japan, they are buying bonds because they need to have dollars. They need to have dollar reserve currency, so they buy dollar-denominated assets to help with that. If we lose reserve currency status and things now are priced in different currency, let's say, for example, I'm making this up. This is not a prediction. It's just hypothetical, so it's an easy example for me. Let's say that all of a sudden the euro becomes a reserve currency of the world, and gold, silver, oil, commodities are now priced in euros. Nobody needs to hold dollars anymore. So what happens is people start unloading bonds. They just start dumping. They don't need to hold dollars anymore, so they get rid of their bonds. They get rid of all the billions and trillions of US dollars that they're holding because there's no need to hold it anymore. You don't have to convert it back into dollars anymore. What they'll do is they'll start buying the euro if the euro becomes a reserve currency because they need to have that on their books because that's the transactional currency. So imagine if all of the major central banks around the world and government started just dumping US bonds and US dollars. You're flooding the market with liquidity. Would not be a good thing. It would be very bad for the economy. And I think would send us to an economic turmoil for quite some time. Now, that's obviously something that it may happen in my lifetime. I'm not sure. I mean, they say that reserve currencies, to have that status is like a 100-year cycle, and I think we're way past that now for the U.S. Let's see. Danny, you made my day with the Revenge of the Nerds reference. Lambda, 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 and Omega Mu. All right, let me go through some questions that came through on the YouTube channel. For those of you who might be new, you can always put your questions below any of the YouTube videos that I have, and I will look at those comments and analyze them and hopefully get to them on the show. Here's a good one from Martin. He says, do you know where I can find past short interest history for certain ticker symbol? Are the short interests reported daily from the FINRA website? It suggests bi-monthly reporting, but I'm not exactly sure. Yes, it is bi-monthly. So the trick with short interest data, and of course there's been so much talk about short interest because of stocks like GameStop and Bed Bath & Beyond and AMC and all these short squeeze stocks. And that will always be the case. There will always be some short squeeze candidate out there. FINRA requires brokers to disclose short interest twice a month. And when it's reported, it doesn't get put out in public for another week. I don't know why that is. So bottom line is, when you're looking at short interest, it's at least a week old, maybe 2 or 3 weeks old with regards to short interest. So there is no real-time short interest. It's up to the brokers to report it. And in my jaded opinion, I think the brokers are lying. I think they're flat out lying to FINRA with regards to shorting. I think maybe they're doing other shorting internally because you might ask, well, how could you say that, Merlin? When you look at GameStop had it was 140% of all the 140% of the shares were short. So if shorting is I borrow someone's share and I sell it to somebody else, that's shorting. How can I have over 100%? How can you possibly sell more than there is, right? I got a bridge I want to sell you. I don't own it. So that has to be the broker saying, we'll honor it. We'll let you borrow it even though we don't have it. So I don't trust that these brokers are reporting to FINRA anyway, but, who am I? I'm just a lowly guy with a YouTube show that trades every day. All right. So unfortunately, Martin, nothing you can do there. Generally, when you look at some of these financial websites, it's going to be 30 days old. So I'm sure that there's sites that will say they have real-time short interest and you have to subscribe to their channel. Don't buy it. You're not going to get real-time short interest unless you're literally getting it straight from FINRA. That's the only reliable source for shorting information. What else? All right, Zed. You guys keep sending those questions. Again, if it's to me directly, put question marks so when I scroll through, I can find them real quick. This is a good one from Zed. I hope Zed's here today. He says, I watched the documentary movie of the China Hustle on Hulu, dated 2018, and found out there is a reverse merger going on between listed companies in the United States, and they changed that to Chinese companies that have never been audited by U.S. agencies. My question is, what is a reverse merger, and is it legal here as in the U.S.? Well, in the documentary, they said that it is. It seems that shorting these companies is more likely to do or just to avoid them, but how are we going to know if Chinese companies listed in the U.S. markets are legit? Well, Baidu, Alibaba, are these reverse mergers? So let me explain what a reverse merger is for you guys just to start out. we've covered a show in this program specifically about SPACs, right? And you can look at my YouTube channel. Just go to the YouTube channel for TraderMerlin. There's a little search engine. You can type in SPAC, and you'll see one that said SPACs. I think I called Necessary Evil or something like that. A friend or foe or something like that. A SPAC is essentially reverse merger. So the way that a SPAC works is they create a publicly traded company, and the purpose of that publicly traded company is to go buy some company that's private and make it a publicly traded company. So let's say it's the Merlin SPAC, right? My fund is called this Merlin SPAC, and basically all I do, and I'm listed as this, is I raise money, and my goal is to bring a company public, and I have 2 years to do that. So I go issue a whole bunch of shares at $10 a piece. I raise $50 million. And now I'm going out there and I'm looking for a company to bring public. So I'm going to go search private companies and say, hey, tell you what, how much do you want for your company? And they say, oh, 20 million. I'll say, I'll give you 30 million. Let's do it right now. And the owner's going to go, what? Well, hell yeah. You're going to give me a nice big perk, a big $10 million more than I want? Awesome. We'll do that. So, and let's call that, well, let's see. That's the fish company, since I'm a fish fan. So Merlin SPAC buys the fish company, and I've overpaid dramatically for it. Doesn't matter. I don't care. I'm making my money off the shares of the share price. So I overpay for the fish company. I buy that, and now what I do is I slowly redo the books, so all of a sudden I can now take my publicly traded company, which is called the Merlin SPAC, and I simply change the name to the fish company. Now, fish company is a publicly traded company. Once that happens, that's a reverse merger. What's happened is that fish company has circumvented a majority of the steps needed to go public. There is intense scrutiny, intense documentation, and rules that must be followed for a company to do an IPO and go public. This way, it's kind of shady. You don't know all the inner workings of that company. It's a way for them to skirt most of those rules that the exchange has put in place for you to go public. Now, that's what a SPAC does. What you're looking at is a reverse merger is slightly different. So there are a lot of shell companies out there, and basically people will start a shell company, they get it on an exchange somewhere, usually it's on the OTC bulletin board stock, and they'll just list it there. What will happen is a company, let's call it Tsingtao, which is one of my favorite Asian beers. Tsingtao, right? It's a beer company, Singha is out of Thailand. So let's say it's out of Thailand and they want to go public in the U.S. Well, there might be rules which might prevent them. If they decided to go public in the U.S., there's all kinds of scrutiny on their books. How can they get around that? They would go to a shell company and start buying shares and get to the point that they own 51% of the shares. Once they have that, then they can vote to buy all the other equity for Singha, and then now Singha just takes over that shell company and moves in. Basically, it's like a hermit crab, right? It just finds another shell to move in. Kind of a weird analogy there, but is it legal? Yes, it is legal. Are there rules against it? Well, when you do mergers like that, there's supposed to be some scrutiny on when those reverse mergers happen. From what I've been reading, and there's a lot of it, is that the U.S. has offered a significant amount of leniency to Chinese companies to do this. Whereas other countries, there's more scrutiny on it, which personally I think is obviously wrong, but it is what it is. So, one way for a Chinese company to go public in the U.S. is simply go find a shell company that's really cheap, buy up 51% of the shares, and then move into that house, change the name, and now you're publicly traded. So that's how it works. I don't know about Baidu and Alibaba. I believe those were straight up IPOs, but I could be wrong. I don't remember. I'm pretty sure those were IPOs, but anyway, I hope that explained it, Zed. It is totally legal to do a reverse merger. It's the levels of scrutiny for Chinese companies has been questionable, whereas like a German company wanted to do it, they would have to provide a whole bunch of different documentation. And for some reason, there has been absolute leniency with regards to Chinese companies doing reverse mergers, and we're seeing a lot more of those. Are there too many systemic risks to invest in China still? Personally, for me, I would say yes. It's just the government risk. You're dealing with a communist country, right? The government there, at any moment, regardless of your title, your deed, whatever you have, they can literally go, you know what, you don't own this anymore, it's ours. Done. So let's say you start a company in China, it's doing really well, it's a fantastic company, its business is booming, and like, I'm killing it. China can come in there and say, nope, you're out, it's ours. Where's my record? Nope, it's ours. It's our company now. China can do that. Now, can that happen here in the U.S.? I guess theoretically it could, but the odds are no. We're more democratic. There's rules we have to follow. It's not a totalitarian state. So that, to me, is the big issue and why I don't invest anything in China, because I might invest in, I don't know, maybe I invest in a semiconductor company directly, right? Put my money directly into the company, or maybe I buy shares of some other company. I could be kicked out. Shares could be taken away. Nope, I just don't trust it. And the last part about Zeds is, how do we know? The problem with reverse mergers is you really have to do a lot of digging to find out the history of these things. When someone does a reverse merger, their books may not be in order. They may not be a financial powerhouse. They may be just struggling and just trying to get on the U.S. exchanges. So you really have to do your due diligence. If someone's telling you, hey, check out this stock because, it's going to be great, do your research. Never buy anything because anybody tells you to. You have to be the one that tells you, I'm going to buy this because of X, Y, and Z. All right, Karen. Are you here, Karen? I thought I saw you earlier. No? Oh, there you are. Karen's here. So good. This question is for you. Does the length of time that the bonds are inverted determine how long or bad a future recession will be? I wanted to ask this with Bill was on, but it's not available for the live session, so no problem. Personally, I don't know. I don't think that there is a direct correlation with how long it's inverted. Just remember, the longer it's inverted, I just think it means that there's more pessimism out there. Now, how long will that last? Not exactly sure. So let me look at a chart here, and I think this may actually help you out. So here is a chart of the yield curve, and this is the 10 and the 2, right? The difference, take the 10-year, subtract the 2-year maturity, done. So anytime it's below 0 would be an inverted yield curve. Now, you can see there's been a few of them. You can see back, obviously, we've had this one. It just barely tiptoed back in 2019. We're under it now and actually accelerating down. You can see back here in 2007 and 8, we were below it. Back in 1999 and 2000, we were below it. So there's been quite a few. And then the gray bar here illustrates the recession, right? The recession period. And what's interesting for me, and I hope that everybody notices this one, I have a hard time explaining this to people without a visual chart, and that's why I love having you guys here. I'll bring up the charts for you. If you look here, oh gosh, nabbit. Drawing tools, man. There you go. If you look here, let's just go back to the one from 2008, right? We were below it, came back above it, and then drifted down below it again. But notice that right here, we literally bottomed out here, 2009, right? We bottomed out in early 2009, which is right about there. So even though we had an inverted yield curve, it took another 18 months for the markets to crash. So the yield curve was inverted before we started crashing. Same thing here. If you look at this is actually late 99, early 2000, but we inverted back here in 98 as well. So it takes a while for these gray bars, which is a recession, to actually show up. It goes inverted, and then a year and a half later, we'll go into recession. That seems to be the norm, and it begs the question, where are we now? Right? If you look at this one we had in August of 2019, which is over here on my right side, all right, we just barely tiptoed across it. It took about 8-9 months till we hit a recession. Now, granted, it was very brief. That was the COVID recession. But right now, our recession, based off this, it shouldn't hit till next year. And it could be, a June, July kind of thing where we actually get the recession piece. And, what's noteworthy for me is this period, I'm going to do a red box here, which is from where we inverted to where the market bottomed. That obviously is a long period of time. And there were substantial declines there in that yield curve. And the yield curve even corrected itself as the markets were tanking. Same thing back here in 2001. Remember, markets sold off in 2001, didn't bottom till 2003. So I don't know. I don't know if it necessarily dictates how long the recession will be by how long it's below, but certainly it doesn't paint a very pretty picture for the markets going forward. Now, we don't know how long we'll be below this. What I did find interesting, especially when I look at the chart, is it looked like we were trying to get back above it and then just started to fall apart. Here's the current chart right here. So here is a monthly. Here is the daily. And, you can see we looks like we started to rally back up. Looks good, and then just starting to drift back down. So not sure how long we'll be below it. It shouldn't be below for a long period of time, but it could be. And I just think the longer it stays there, the worse the prospects are for the economy going forward. And I don't have any empirical evidence other than just analysis of charts like this, Karen. Unfortunately, Bill Addis may have had better info. Maybe we can write that one down and ask him for next time. Chase says, in October 18th, 1981, inflation was running 12%. The recession was nearly a year old before President Ronald Reagan started. The economy was... I just think, remember, we are in a bad position now. When do we get out? And I think that this is a different situation. All right, I believe personally right now we have an everything bubble. I think it's housing. I think it's equities. Bond markets have been bubbled because the Fed has just been buying everything. I mean, riddle me this. You've had a robust real estate market, one of the best housing markets we've ever seen from price appreciation perspective, and the Fed is still buying mortgage-backed securities. Excuse me? It should have nothing to do with the housing market right now. I mean, they're creating this artificial bubble. I hate it. So to take this one step further, Karen, and I think that this would be beneficial for everybody, is it's one thing to look at this yield curve and see, okay, well, it was inverted here, and we had a recession, blah, blah, blah. Why don't we go and look at this with a chart? So what I'm going to do is throw over, this is the S&P 500, and what I'll do, and it's hard for me to do these two on top of each other, but I really lined this up basically since 1978. I know we could have gone back further, but I wanted to show the most recent ones. Now, to add to it, I just continued on these recession lines. So notice where we started back here in 1999, right? Markets really kind of peaked in 2000, but we already had an inverted yield curve kind of a little bit before that. And we ended up with 3 years of just down move. You look at where we are right now, which let's go to the 2008, 7, and 8 one. You can see we had that inverted yield curve was actually 2006 and 7, we went inverted, and then they were aggressively trying to fix it. Well, notice how far that market fell during that recession piece, which, and again, I'm not trying to spread fear or anything like that. What I'm just trying to say is these are historical market patterns that are very clear. When you have an inverted yield curve, about a year later, we go through a pretty substantial down move in the markets. And, here we are right now in the midst of still being inverted. I'm wondering how substantial that move might be. And if it's a year out, that means that next year, July, August, September, maybe, we really start to feel the pain of this market inverted yield curve. Now, other piece that's interesting is, even though this was inverted in 2006 and 7, remember, markets really sold off from 2008 to 2009. This is really like a 1-year blip. Whereas back here in 2000, it went from 2000 to 2003. I mean, this was like a 3-year decline, whereas this one was about 18, 19 months. So how long will they go? Not exactly sure. But the longer this stays down, the more it makes me feel like we're going to have a big pullback like you see down at the bottom of this chart, things like this. We haven't had that. And just so everybody is clear, this move right here that I'm circling, that was a 50% decline. This was a 57% decline, and here we are now. What are we going to get? I don't know. I mean, we've already dropped 20 off of that, but that really wasn't because of this inverted yield curve. That might have been because of this first one. This couple days that we were inverted. Well, we've been inverted for weeks now. So, it's not guaranteed. Nothing's guaranteed. And I think the point I'm trying to make is just prepare yourself, and if things start to continue to flow, then backpedal away from your bull positions and go to cash, which has been a great place since the dollar's moving up, or potentially start building yourself some short positions. If you're a really long-term investor, you could be selling puts way out of the money that probably aren't going to get hit, and if they do, well, you bought the market a lot lower and you collected some premium. All right, what does Richard say? 2024 to 2025 should be out of this market. Might rise when the Fed comes off the gas in mid-2023 since market is forward-looking. True, but before I worry about the markets recovering and the Fed getting out of the way, I'm waiting for the markets to do what historically they've always done after a recession, which is have a pretty significant sell-off in the markets. And I wouldn't call our current position that we're in a significant sell-off. 10% for me is a normal pullback. 20%, okay, now you're talking an okay pullback, but it's still not epic. Now, this one was pretty good. If we go from peak to trough here, roughly 24%. Okay, that's pretty good. But my brain, and I know I have a weird brain, you guys you understand that, says, what if we get something that's comparable to historical moves? like that 50% or 57%. I think we're due. Well, that simply puts us back down to these 2020 lows. So that's not even that far-fetched, the grand scheme of things. And I think that's a very real target if we do go into a prolonged recession. But anyway, I'm more of a perma bear. I'm definitely, if I have a scale that says I'm more bullish than bearish right now, I'm certainly more bearish overall. I just can't see the current situation ending in a very positive light. I think we've been inflated way too long. I mean, yeah. I just had a very bad analogy I was going to say, and I'm like, you know what? I probably wouldn't want to say that analogy, but yeah, I think that there's some bad stuff going to happen here going forward. All right, what time we got? Okay, GD, I know you're here today. I really wanted to talk about your. GD sent a really great question, and again, if you have questions, you can always send them in and put them under any YouTube video or the email on your screen, which is TraderMerlin@gmail.com. What I'm going to do, GD, is probably on Tuesday. So next Thursday, I'm going to have Larry Jacobson on. I'm going to try to get John O'Donnell on next week. But I think next week I will address your question directly and do a whole show on it, which is really, I'll read the question now, but I'm not going to answer it yet. We'll talk about the ultimate tease. Sorry, GD. But I just think I want more time for this, and I really want to come up with some examples for you. Here's GD's question, which will set the tone for, it'll either be Tuesday or Wednesday, depending on when I get John on. I'll do this on the free day. It says, do you think it is wise to set daily financial goals, or is it focusing too much on the money and not the process? Many people say you must have goals, something to aim for, to measure against. However, I set a goal like $500 a day, which seems doable, but I can't hit it. I get close and something turns around, I fall short, then I drop to 300. So I'll walk you through this, and it's really important. I think it is important to set goals, although my goals are a little bit different in the thinking, and you guys can probably already guess what that's going to be. Targets are something that I think are good. However, they can be a serious Achilles heel to you. And I think you kind of addressed it in there where you're like, oh, I want to make 500, but I can't hit it. When you set a goal for 500, which is doable, and you're getting to 300, and you're consistently doing that, you're still doing damn good. You're making $300 a day. But what does your brain tell you? Oh, I'm a failure. I can't do it. No, I'm not getting my goal, man. I must suck at this. You're doing great. Make $300 a day. So I'll walk you through how I had my self-discovery, my aha moment, where it made me click what the important thing was to focus on. But I think a lot of people misuse goals, and they focus on just the money. So I will cover that one. All right. Let's see. There were a couple questions that came through in the chat here. Let me go back through. I thought I saw some question mark. Indigo says, will it be a real recession, a technical recession, since this is really stimulus-driven? I don't know. My gut tells me that we are going to have some serious economic turmoil due to multiple factors. Declining prices of bonds, yields surging, right? Cost of capital surging. The removal of U.S. dollars from money supply. It's going to drive the dollar up even more. The foreigners looking to buy U.S. dollars or buy U.S. denominated bonds because those yields are going to be paying more, and they buy the dollars, they get more for the carry trade. So you got a lot of factors that put pressure on the equity markets. Number one, the dollar rising, that puts pressure on U.S. equity markets. You also have a Fed that has said, expect higher unemployment. I mean, he said in his speech, people and businesses are going to feel some pain. That is a pretty bold statement that precipitates fear. Normally, the Fed should be like, well, the employment market could get a little difficult. That would have said the same thing. But to say that people and businesses are going to feel some pain, those are pointed, sharp words. And I think he probably shouldn't have used those words, because I think that's why you're seeing this market panic. And basically the market saying, okay, what are we going to get now? Is inflation or unemployment going to jump to 5.5%? We're going to see that kind of surge. You're seeing layoffs all over the place. Someone sent me an article for Bed Bath & Beyond. They're doing massive store closures and layoffs. Of course, let's be honest, it's Bed Bath & Beyond. I mean, come on, it's garbage. But yeah, I don't know. There's just, and I'm open to anybody else's opinions that think that this is the beginning of one of the biggest bull markets ever. I'm happy to have that discussion if somebody thinks that it is. Maybe I'm missing something, but you look at all the different factors, and you guys could throw anything out in chat that you want. Say, well, what about this? And I have a whole list of all the different things that I look at. They're pretty much all negative. We did see some of the Empire State Manufacturing numbers were better than started to get a little bit better but nothing's really great. We still have chip shortages. We still have COVID. Who knows what the next variant's going to be? It's been 2 years since the last disease, so pretty soon we'll have another one to worry about, maybe go on more lockdowns. I mean, they've got us conditioned on a 2-year cycle, everybody. All right, soft landing, aka engineered recession. I don't think it'll be engineered. I think that at a certain point it's going to hit hard, and it's going to be one of those things that it's going to be hard to stop it. Do I think it's going to be like a 75% collapse? Absolutely not. I don't think it's going to be that bad. I mean, we're resilient enough. We still have the strongest economy in the world. We'll bounce back and get back on track. But if you look at these charts, it doesn't matter what time frame you look at. You can bring up any chart that you want. I'll look at the S&P just because that's, for me, the dog that wags the tail. If we look at this on a monthly, you clearly see that this is totally different than normal. One of these kids is not like the other. And I've always point out these two camel humps back here, which were 50% market declines. Now, I know Tom's probably here, and he's like, well, let's look at a logarithmic scale. Okay. We still have this colossal move without a major pullback. It's just market behavior. It's going to correct itself. I mean, we have not, I guess, created such a perfect marketplace that this thing's going to go up forever. It's going to have a pullback, period. The good times are over. Well, I don't know if I would say that, Robert. I think it's good times are what you make it. And I'll probably get some grief from the people here because I'm always saying, look, don't spend as much. You should be locking down your capital a little bit, and you know what, not even as extravagant, and maybe not taking wild trips. Of course, here I'm going to go to Europe for 2 weeks, but at least I'm getting more bang for my buck. When you see from multiple fronts, whether it's the equity market, the bond market, the housing market, that things are starting to turn and slow down, that's the point where you go, okay, let me batten down the hatches, right? Let me protect myself a little bit, maybe build up a little bit of a financial cushion. I mean, you never know. Another round of layoffs could start coming around. If Jerome Powell is correct and people and businesses will feel pain, if businesses feel pain, what's the first thing they do? Layoffs, and they start selling off. So, it's not like I'm a doom and gloom. It's a realist. It's saying, what does business and economic cycles look like? When businesses struggle, they do layoffs, right? If people aren't buying goods and services, they're going to do layoffs. So they lay off more people, and those people have less money to spend, which means you get that downward spiral, and that will last for 18 months, a year, a couple years, who knows, right? We saw it back in 2020 or 2000. That was 3 years. We saw it in 98. That was a year and a half. Is this one shorter or longer? I have no idea. All I know is that we are long overdue, especially considering that money supply has gone from $4 trillion to $19 trillion in 2 years. It was one of the most unbelievable statistics I've ever seen in my financial career, is that number, that they put so much money into the economy. And basically when you're giving money away with those PPP loans and all that stuff, and non-payable, you don't have to pay it back, you're creating artificial wealth. And the smart people took a lot of that money and made their lives even better. The not smart people took that money and bought themselves new TVs and put themselves further into debt, right? Anyway, sorry, I'm ranting. S&P will hit 85%, me down 85%? Ooh, I don't think so. I mean, it sounds awful. If it does, I'm okay with that, because that means I most likely am going to be short. So let's see, 85% would put us... 85% would put us at 582 on the S&P. I hope that we can play this back and I can be laughing myself, but no, we won't go to 500. We're not going to go that low. There's no way that would happen. Could we go back to, these lows down here at 1800? Sure. Absolutely, but I do not think that we'll go down to 500, but you never know. Best Buy is laying off and closing a ton of stores. Yep, that they are. And, but Bed Bath & Beyond, we talked about this. It's trash. I mean, literally, you guys go, if anybody wants, we'll do it next week. We'll do it live. You go to Bed Bath & Beyond and walk through the store, and I'll have you on your phone. You can FaceTime me live. And as you pick up any item, I will go onto Amazon and I'll buy it at least 3% cheaper, maybe 20% cheaper on Amazon, and I may even be able to have it delivered the same day. So why would I need to go to Bed Bath & Beyond? And I don't know if you saw some of the restructuring things. The new CEO is like, well, we have a lot of things we can do to revitalize our company and get people interested in us again. It's like, well, I'm pretty sure you can't. What are you going to do? You create all new products that nobody else has? So yeah, you're going to start seeing more layoffs, not just Bed Bath & Beyond. Look at a lot of companies that are being displaced by technology. And this is, something that if you are in some of these industries, you should always be aware of. But, look at where you're situated and saying, is technology doing something to replace me? Well, the internet did something to replace stores like Bed Bath & Beyond and Sears. Now, Walmart did a good thing because they were super cheap. But, Walmart lost a lot of business due to Amazon. So what does Walmart do? They now have online as well. So there you go. Thomasina, see, Thomasina is the smart one. And you're right, Best Buy has great coupons. And if you use the coupons, you'll actually do better than Amazon. So I stand corrected. However, most people don't use coupons, which just cracks me up. My girlfriend gives me a hard time. I'll be somewhere and I bust out some coupons and she rolls her eyes. I go, you realize I just saved us like 30% on the grocery bill. Roll your eyes all you want. That's 30%. $100 bill or $100 grocery bill. I saved $33. Come on, man. Coupons are great. Don't feel silly using them. Big grocery store sells many kitchen items. Yep, absolutely. So now what did you do? You throwing out crypto? What time we got? Oh boy, 10 minutes left. And where's Big Eb? Big Eb's not here anymore, huh? So, crypto's been in the doldrums, right? It's just been traversing sideways and doing nothing. Now, I own a lot of Litecoin. Litecoin's been a nice move lately, but grand scheme of things, where's it at? All crypto looks like this. It's really been sideways unless it's really a trash one and they're actually drifting down. But, everything here is pretty much sideways. EOS is doing great. That's because they have a hard fork coming, which, and this is a blessing for EOS. I could see actually much more upside potential here for EOS. Celsius, I can't believe that thing's even around anymore. I mean, Chainlink, it's all pretty flat and boring. So until we get past this whole stablecoin issue and USDC, UST, Luna, all that debacle and the lawsuits get settled, I don't see I'm not really bullish or bearish. I think you'll see sideways action. I kind of think it's going to drift down a little bit. However, things like Ethereum, now they have a merge. It's going to happen where this vertical blue line is. That's September 15th. And if that goes swimmingly, you could see a nice surge in the price of Ethereum going forward. But, not a lot of really great plays out there in crypto, even though I did buy some more. I bought some more Bitcoin. I bought some more Ethereum. But yeah, that's it. When something is exciting in crypto, I'll share more of it, but it really is not much exciting going on in that space, even though there's some great projects. Cosmos this is one I like. I purchased some more of this one recently. Chart looks great. Uptrend, higher highs, higher lows. So that's why I'm adding to that one. Engine, has not been that great. I'm not adding to my position. Do I like Matic Long? Yes. And the main reason I like Matic Long is Matic was just purely a layer 2 transaction, but now they are branching out into a wide variety of different projects, NFTs and different gaming. So I do like Matic. If I had to choose between like Matic and Link, though, I would take Chainlink just because oracles are absolutely critical. Even though this price chart looks really bad, oracles are just necessary for all these DeFi marketplaces, and anything to do with cryptocurrency transaction pieces need smart contracts which pull oracles. So there you go. Shiba Inu had a good pop. Now going to move lower. Shiba Inu is going to go to zero unless they do something epic with their technology and they get big people behind them like Elon Musk. This thing's just going to disappear over time. It's a shitcoin. It doesn't really serve a purpose. There's so many other things that are faster, more efficient, and this one is a joke coin. Now there is, with regards to Shiba Inu, they are building different projects, but they're just money grabs. So they're coming out with their own blockchains. They're coming out with NFT marketplaces, but it's all under different coin names, and it's just a money grab for Shiba. So I won't touch Shiba Inu at all. Vassal hard fork, not exciting enough. Well, the Vassal hard fork will be interesting. That's for Cardano. That is going to happen September 25th, I believe, is the date. They didn't announce it, and I think he just announced it today or yesterday, but it was kind of in September, and now it'll happen here in the 25th, I believe is the date, so that's going to be right. Let me put a vertical line on that one just so I can have it for my reference for my CIL students. 25th, there. So, when that happens, there's just a lot of uncertainty. You have 3 major forks going on right now. You have a fork of Ethereum, you have a fork of EOS, you have a fork of Cardano. Once that uncertainty is out of the way, then I think you'll start to see at least more stabilization and uptrends for those specific cryptos. There you go. Amazon should buy Bed Bath & Beyond and turn them into retail. Absolutely. Or just retail centers, right? Just keep your inventory there. Well, that would make a lot of sense. So all the inventory you're keeping in these major warehouses in the middle of nowhere that you have to ship everywhere, well, what if you had it right locally, very close? That would make some sense there. I haven't looked at the book value and see if they could get bought out, but Amazon. What is... okay, oh man, that's a long question. What does staking mean in crypto? So staking is... There's different technologies that run cryptocurrencies. One's called proof of work, where you have a lot of really expensive computers all fighting to solve a computer puzzle. Whoever solves that one first is rewarded Bitcoin and gets to mint a block, meaning all the transactions in that block. That happens every 10 minutes in Bitcoin, and that's called proof of work. Proof of stake doesn't require high-end computers. Just basically you need a normal computer, but you have to put up some cryptocurrency to be what's called a validator, and you get to validate blocks. So let's say I've got 32 Ethereum. With 32 Ethereum, I can become a validator. So I put my 32 Ethereum into the network. I stake it. It's like I'm putting in a stake. That's my commitment. And now if I'm selected by the network, I get to validate transactions, make sure everything's legit and cool. And if I do that, I get rewarded from the network. I earn 2 Ethereum. There's 2 Ethereum made every 15 seconds in the network. That's what staking is. So staking is where I can take my coins and I can either be a validator or nominate a validator, and I earn rewards for that. So basically, I am locking in my cryptocurrency into a protocol. Right now, I'm staking my Cardano. It's stuck in the Cardano network. I don't say stuck, but it's committed to the Cardano network, and I'm earning a rate of return on that. My EOS, my Polkadot, my Solana, all those are staked, and I'm earning a greater rate of return. Some of those give me 8%. My Cosmos, we did the calculation yesterday. I'm getting what we said, 19.7% rate of return for my Cosmos. That's a great rate of return. No problem. Let's see. Kohl's, yeah, Kohl's is a pickup center. I know you can do returns and pickups in Kohl's, but that's a partnership, right? They just have like a space in the lobby. I like your idea. Buy the whole damn store and just make that your warehouse. And basically what they should do is have a store you walk up to, and it's not you walk through the whole store and get everything. It's a warehouse that has a very small display case, and it's basically going to pick the item, guy brings it right out to you, or they'll deliver it to your house in 30 minutes. Merlin spoke against goal setting, but is obsessed. Thanks, Tom. No, it's not that, Tom. You know what it is? I just love talking markets. I don't know. I love talking markets. It's funny because here's the deal. I love talking markets here. Like, that's why I do this show, and I get it all out here. Like, I'm going out tonight. I'm going to go have myself some cocktails, have myself some dinner. I'm going to go, maybe meet some friends. I'm not talking markets. I'm not talking trading. I want nothing. This is my release. This is my unload of all the markets, and the entire weekend, I can think about other stuff. So, yes, and it is almost a 1-hour show. I'm going to wrap things up here. Obviously, Monday is Labor Day. Markets are closed, so I am not going to be doing a show Monday. Thursday, I'm going to have Larry Jacobson on the show. I'm going to try to get a couple other guests as well. I appreciate the feedback you guys have been giving me, so don't think you're being mean. Be critical. This week, I was really battling with the audio. I figured out how to make the audio sound very clear. It doesn't sound all watery, but the levels are really off. And bizarre is, I could show you my screen here, just so you guys can see it. This is what I get to look at every day as I broadcast the show. So here is the stream, right? And I can switch all the different features over here. You can see my microphone right here is pretty loud. Well, here's the guest audio right here. And when I had the guest audio, it was louder than mine yesterday. And it still sounded lower. So I'm going to fix it. I'll get it there. But I appreciate you guys giving me some feedback on that one. I will try to get my audio dialed in. The good news is it doesn't sound like absolute garbage. Garbage. Tilly. Okay, so Tilly is still working on getting some CFP credentials, and I think the entity she was working with didn't want her on social media, but I'm still pushing. Good. I'm glad you guys liked the audio yesterday. Ryan Watkins had some personal issues. He told me in a couple weeks he's going to come on, so yep, keep asking, guys. Ryan Watkins, I reached out to almost everybody you asked to get him on the program, and hopefully I will soon. All right, let me, well, the audio is great today because I'm by myself. It's the guest audio that's been a challenge, and I never realized what was happening is when I would put it through my speakers, so anytime I had a guest on, it was literally picking up whatever the guest was saying through my microphone, and it sounded distorted and watery and alien sometimes. I can't believe I did it that bad for that long. So thank you guys for helping me fix it. Anyway, I got to go before I get that 60-minute show. Thank you guys so much. Hope you have a great weekend. Do something fun this weekend. It's a 3-day weekend. It's going to be hot as heck, but I hope you all do something fun. I will see you on Tuesday's show, maybe with a guest, maybe not. If there's no guest, I will tackle GD's question about setting goals, and kind of how you should map out your roadmap to success personally. Take care, everybody. No donkey of the day today. Don't even start, Daniel. It's too late. All right, everybody. That's it. I got to get out of here. Have a fantastic remainder of your evening and a great weekend. Cheers, everybody. I will see you all on Tuesday. Take care. What is it? What do you want?